We all want more time with our dads, brothers, partners, friends, and our sons. Together, we can stop men dying too young by tackling the big issues. It's time to act. Sign up at Movember.com and raise funds to help change the face of men's health.
Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in, is it Farmer Services? I always get that right. Huh?
Yeah.
Firm Services firm, one of those.
Let's just stick with it.
Over in Brentwood, Tennessee. She is the tax expert when it comes to individual and small business owners, helping you with your taxes and that. And she also, again, she's an enrolled agent, can help you represent you have problems with the IRS with taking care of those, because you don't want to be dealing with that directly. You want to have an advocate who knows the rules and knows the laws and can help you.
Great tax. I mean, you can't really do retirement planning if you owe the IRS.
Oh yeah, absolutely.
So I mean, you have to deal with that issue before you can really move forward. So
this is true. That I mean, exactly. You can't build. That's like a house on sand. I mean, you're not going to get anywhere because it's you can build something up, but the IRS is just going to take it back.
Exactly.
You know, get that out of the way. In particular, when you look at interest and penalties and the kind of charges they hit you with,
no advantage.
You know, you cannot. There's no way you can invest to stay ahead of that. Okay, that's the worst place to get money is from the IRS. So yeah, pay your taxes. Make sure that that's taken care of in advance. And yeah, when it comes, this goes to, and I'll take that a step further. Debt is another one. You know, when it comes to debt, you don't, you know, minimizing debt or eliminating debt is another important part when it comes to investing. If you're paying double-digit interest on credit cards as an example, you're not, again, and you're putting money into a retirement account, well, you know, that's not real. Okay, you're losing money. Pay those credit cards off. That part of debt needs to be taken care of, and that might mean suspending adding money to a retirement account long enough to get that done. When it comes to home mortgages, that's an exception because those rates are going to be a lot lower, and that is going to work out to your advantage. And there's other trade-offs on that one, so that would be the exception when it comes to
really
debt.
quick on credit cards. If you decide that you're going to try to get out of debt with them and you negotiate with them, just keep in mind they may negotiate a dollar amount, but that does become taxable income to you. So if you say, hey, you know what, I'm going to pay you $5 and I owe you $10, they very likely will send you a form at the end of the year where you will pay tax on that remaining $5,000. So don't think you kind of got away with much.
And this is one thing. Now, hopefully, you know, most of my clients that are coming in, we don't have that kind of issue, fortunately. What we're talking about is how to invest for the long term, and we're talking more concerns are going to be about minimizing taxes. You're going to higher tax brackets, you know, how to, in fact, reducing taxes is a huge one. When you're getting into the higher tax brackets in particular, and we're going to talk the 28, in fact, let me throw this up here. Here's the agenda for today, 2018 tax changes in the second half of the program. We're going to be talking about what these tax changes are with the passage of the Tax Cuts and Job Act. So for this year, the implementation of it this year. So Medicare investment earnings surtax. This is a big one. This is going to be another, you know, 3.8% in taxes. We're going to give you some tax planning tips. We're going to talk about some end of year things that you can do as well. Recent rule changes affecting IRAs, you know, retirement accounts. This is a big one. We're going to, there's some court cases even that are referenced there, and 60-day rollover rules. All right, so on the next slide, 2018 income tax provisions, this shows the actual tax brackets. Yes. And we're going to talk about this Friday a little bit about this top rate and what that looks like compared to, say, 2017.
Right. So, I mean, I guess you have a couple different things. When you start getting close to the top rates, you'll see that the marriage penalty starts kicking in, especially when you get to the 37%. But, you know, the average people, the penalty really isn't in there as much until that point, until you get up to the 35 and then the 37% brackets. But in comparison to the prior tax law, we had 39.6 was our highest rate. So we're all very, very happy that the highest rate has been reduced by almost 3% all the way across the board. Exactly
right. And this is one of the things when you look at these top brackets, when Friday's talking about that marriage penalty, if you look at for a single person at the 32% bracket, if you double that number, basically for two, it's the same for married filing jointly, but now look at the 35% bracket. There's that penalty.
It's good to be single.
From single, two single people would have on the upper end of that basically 500,000 times 2 is $1 million. compared to the married filing jointly only $600,000. That's huge in terms of that bracket, meaning that at $600,000 you jump into that top bracket for two people, married couple, whereas two individuals would need $1 million, $500,000 each, in other words, to jump into that same bracket. So it is a marriage penalty, and we're going to talk more about that piece as well. And of course, we talked a little bit about capital gains and qualifying dividends and how the tax rates work. This used to be in 2017 tied to the tax bracket. Now it's tied to a dollar amount, which is going to be tied into CPI.
It's really important. These numbers, especially when you're looking at the 10% on the top of that slide, if you're an individual that has maybe money in an IRA and you decided that, you know what, you only have Social Security and IRA, this is the time to really be looking at these numbers, because you might be able to do a conversion and almost for 0 or 10% tax. Same thing with capital gains. There's a 0% capital gains for individuals making 38.6 or married couple 77.2, and that's actually a little higher because that doesn't include your exemptions or your standard deduction. So this is the time to be looking at those two areas and saying, hey, could I be converting or taking money from my stock portfolio and maybe putting that money somewhere else out of the tax deferred situation and taking it out actually for 0 tax. So those numbers are really important to watch out for.
There we go. We want to minimize tax, and 0 is about as minimum as you can get, right?
We do like 0.
We like that.
We
That's
love
great.
0.
Imagine that you can get capital. Did you even know that? I mean, were you aware that you can take capital gains, you can make a profit on individual stocks on your portfolio and not have to pay a tax? This, by the way, could also hold true for real estate. So watch, you know, these are things to watch for. All right, on the next slide, we're going to talk about the changes. This is one of the big ones. This has to do with exemptions and deductions for 2018, which is this is one of the biggest changes.
This is probably one of the largest, and people don't totally understand. I mean, they understand that the standard deduction pretty much has doubled. So whatever your standard deduction was before, pretty much double it and you'll be safe. So single, $12,000, married couple, $24,000 if you're under the age of 65, head of household, $18,000. Here's the tricky part. That sounds great, but the personal exemption has been eliminated. That was $4,050 per person. So if you have a family of 4 or 6, that's a big drop of your, so they may have doubled my standard deduction, but they completely wiped this out of the elimination. So if you have more than 2 or 4 people in your house, so especially if those children are over the age of 17, this is where you may find, even with a 3% adjustment, that your income taxes didn't change as much as you thought it would. So you really need to watch that.
Right. Most everybody's going to get a decrease in taxes, at least in the ones that I've been running, but there are exceptions, and one of those would be even a couple. I mean, well, you got, hopefully you get the tax credit, but yes, if you're older people, you're not going to do, I mean, a child tax credit,
if you've always itemized, for example, I'm not going to see the tax credit probably because I've always itemized and I'm going to lose $4,000 in personal exemption. The question will be, will that 3% across the board reduction of ordinary income tax actually offset it? And that's what we're kind of waiting to see exactly how much, because my incomes are kind of a roller coaster, not a perfect, but that's the big thing. So preparing for that, talking to your tax person would be very important to really make sure you understand those. Now,
one of the things too, this is one of those, that ghost tax, the AMT, alternative minimum tax. This one has been changed a little bit as well. The income thresholds have been increased, but it's still there. For those, you may not even know about this alternative minimum tax, but basically this is one of the reasons when we're doing tax planning with clients that I'm always calling Friday to have her run returns for us so that we can see, all right, if you've got an accountant that can do this, that's fine too. But what we want to see is what impact is this change going to make, and is it going to trigger this alternative minimum tax, which could take away the benefits we were hoping to gain.
The thresholds are pretty low still on those, so it's like $40,000 for a single and like $75,000 for a married couple. So in theory, a lot of individuals could end up hitting that, and then you're at a 24% tax bracket instead of these other brackets that we're talking about.
And here's something to keep in mind. There's a lot of planning opportunities, a lot of ways that we can reduce taxes under this new plan, all right? We're going to take a break here, but first let me just finish with this part. When you're looking at the tax breaks, okay, when you're looking at this tax law, we can go ahead and get rid of that slide for now. when we're looking at that tax, the tax law sunsets in 2025, okay? So we basically have this 7-year window to take advantage of. Now, it's possible it could be extended. It's possible it could be made permanent. There are a lot of different factors that are going to, over the next, 6-7 years, that are going to basically determine that with regard both to the economy, the debt, the deficit spending. All of those things are going to come in. Can we, in fact, grow our way out of debt? We're going to find out, it looks like, over the next few years what the effect that's going to have. We do see that even though the deficit is increasing compared to what it was in the 8 years prior to this, it's decreasing at a lot lower a tremendously lower pace. But at the same time, it is increasing, and we want it, so even though it's slowed dramatically, we want to now see it reverse and start to reduce. When we see that, that's going to be really encouraging, and that could then help with regard to these tax cuts. And now they're even talking about potentially additional tax cuts. That'll be interesting to see as well. So there's a lot when it comes to taxes. This window, though, let's just look at it from the standpoint, we know we have the 7-year window. Let's take advantage of that, and there's some great strategies we can implement. All right, when we come back, we're going to get into some other pieces with regard to this tax legislation, and again, some tips that you can use to reduce your taxes this year. All right, so join us here. We'll be right back on the Retirement Report.
You've been smart and saved for your retirement.